The board does not have the authority to assess its members that greater than 5% of the total budget as a specialist. The two worst insurance markets right now are Florida and California. Why? Because those are the areas where climate change is having the biggest impact. You get hit by these unpredictable, unknown, uninsurable, catastrophes. You have assets to deal with.
Hello, everyone. Today is May 29th. My guest today is Scott Clements. Scott is the CEO of Reserve Studies Incorporated. Thanks for coming on the podcast, Scott.
Yeah, welcome. Thank you.
So just before we started recording, you were mentioning that there are 12 states in the United States that now require some sort of reserve analysis done in communities. Is that correct?
That's correct. The number's up to 12. Community Associations Institute and the Foundation for Community Association Institute Research, they have put together information as recently as 2023 statistics, and 12 states now require some requirement of a reserve study. Some required annually, some required every 3 to 5 years, some are a couple years. So they vary from state to state because, of course, real estate is regulated on a by state basis for the most part. But there are 12 states now that require a reserve study of some kind be available to membership and then, of course, in the resale value. There are also 12 states, most of them are the same, but there's a few variances that require some level of reserve funding. So again, the amount, most of them use a term sufficient or adequate. So, there's a debatable point on how much that is. Generally, that would be considered cash flow, and we can go into some of the different terms. But whether they require a percent funded, a dollar amount, or these more ambiguous, sufficient or adequate amounts, they're requiring that money to be set aside. So clearly, they've recognized the fiduciary duty of a board in any state to have some money set aside for the future, because obviously the age and deterioration is inevitable out there. So they've recognized that in 12 states. Now we're up to 30 states that require some level of disclosure on resale. So when you go to sell in a condominium association, you're going to have to disclose, again, its reserve status. And it varies by state. So again, whether it's a dollar amount, percent funded, adequate, sufficient, any other term you want to use, you have to indicate where you are. Most of them are dollar amounts. So again, whether it's 5,000, 500,000, or 5 million, you're going to know how much is in there comparable to your association. Whether or not you have the skills to judge if that means anything, like, okay, $50,000 is a lot of money to me, but for a 30-unit apartment building that's 25 years old, that's not a lot of money at all. So being able to understand how much that dollar amount equates into where they are is a whole nother thing. But at least they're recognizing the idea that you should be aware of what your long-term needs are to maintain the property. Again, the Foundation for Community Association Research put out a lot of statistics, and I believe one of them was the age of property. So for instance, in Los Angeles County, it's upwards of 74 years old, I think was the number they gave us.
Wow.
On that. So yeah, the average age of properties in some of these communities, we forget, Los Angeles is decades old, centuries old now. So a lot of the aging infrastructure out there is coming to a point. Reserve studies have always been on that 30-year philosophy, which is a long time. So most components last less than 30 years. If you go through almost any kind of dwelling, most of the components are going to last less than 30 years. There are a few, potable piping, drainage piping, electrical circuitry, those kinds of things that are expected to last longer. Now, whether that's 75 or 100 years, almost none of that is expected to last more than 100 years. So now that we have a lot of homes in these developed areas, whether it's on the East Coast, the West Coast, et cetera, obviously the East Coast probably laughs at our 74 number. There are, communities hundreds of years old. So the infrastructure within those buildings is going to have to be dealt with because you're having so many of them get into that advanced 75 to 100, in which case, almost nothing is off limits. Branch circuitry, other things that are, quote, considered lifetime are going to have to be included. A lot of that has to do with the expectation. Prior to, I'll say, the 1950s and 60s, when they built a residential structure, whether it be apartment building, single family, the anticipation was about 100 years. Like, well, within 100 years, we're going to do that. By the 1970s, that expectation was down to about 50 years. So most of the time when they're building, they're assuming that, yeah, within 50 years, you're going to do a major reconstruction project. So we don't have to make everything last more than 50 years because you're going to do something different with it anyway, whether it's tear it down entirely or, 3-wall construction, reconstruction. It's just not going to be the same 50 years from now. It's a long time in the process, which, has turned out to be, for the most part, true. Obviously, there are situations where it's the outlier, but yeah, most people are severely rehabbing their property much sooner than 50 years. So 50 years is a pretty good long timeline, but nonetheless, as they saying goes, it's not made like it's used to. Well, it's not designed to. It's not designed to last as long. We're using a lot more plastic, less iron, which of course, has an indefinite life expectancy as far as degradable, but it can crack and it can break, it gets brittle. So it's not an indefinite product in almost any application. So any of these infrastructure items, again, plumbing supply, plumbing drainage, gas piping, electrical circuitry, certainly roofing, whether it's short-term product, and by roofing, I mean short-term 25, 30 years, or long-term products. We have a lot of slate on the East Coast, a lot of material that's designed to last 50, 60 or more years. That now is 50, 60 years old. So the underlayment and the structure underneath it is probably subject to deterioration. So you have a lot of communities of an age where they look great from the outside. They've been well maintained, they've been painted, all that, but there's just aging infrastructure that's antiquated or starting to fail. That's going to have to be replaced. So these are some of the costs that haven't always been captured. Community Associations Institute changed its standards, updated them in 2023 to put a greater emphasis on that. So there used to be a lot of discussion about 30 plus. Now, if the life expectancy is predictable, so if for the expectancy, we'll just use copper plumbing, infrastructure, potable drinking water, copper plumbing. If your expectation is that it's 50 years, long time expectancy. All right, well, from day one, it should be in the report. So you start down 49, 48, etc. Don't wait for that 21 years where it comes into the window and is now less than 30 years. California and other states have requirements for less than 30 years life expectancy funding. So that's been a big milestone in the industry. But the idea is, well, why do we wait? If it's predictable, then let's start at day one, no matter how long it lasts. The other thing is to make sure you get a lot of things in there, even if they're placeholders. So I'll use the here in California and all over the country, but particularly here in Southern California, we use a lot of natural gas. So there are a lot of natural gas systems out there. Natural gas itself is non-corrosive. And unless it's in an ocean environment and failed to be maintained, it generally lasts, again, the life of the building. But eventually it's going to wear out, deteriorate, and you're going to restructure the property in such a way that's probably going to require it. Not to mention there may be new technologies, or in some cases, specifically in California, where they're discontinuing the use of this product, natural gas, in small appliances because of its climate impact. So nonetheless, there will be changes of some time that this natural gas systems will have to be replaced eventually, but at what point? So at this point, I would say if you're in a 20, 30, 40-year-old building, probably still not even predictable in the next 30 years, in the next 40 years when it's going to happen. So it's fine to put that as a 30 plus, no funding, and we'll wait till we get more information before putting that kind of liability on the association. But people have always shied away from putting an immediate funding because they think it adds this massive liability. Well, quite frankly, a roof, that depreciates over 30 years might cost less than your water heater just because it only lasts, 7 to 10 years. So you have to look at the cost and how long it lasts when you're talking about the total annual cost and value. So a lot of these components, you can't estimate it, so that's fine, but let's put it in the report. Let's put it 30 plus. And so last year, the CAI standards were updated to emphasize, let's put it in there if we can identify it. Start funding immediately. If not, then put it in as a placeholder because eventually it's going to have to be replaced. So that still will fall through the industry over a few years as evolution takes on. But you should start to see more components come into a reserve study, particularly the infrastructure. As I mentioned earlier, those that operate in California, and there are some other states that are requiring the use of electrical EV chargers and other things. They're getting very popular in many communities. So they're going to be part of the establishment moving forward. Well, obviously, a lot of these homes, particularly the ones that are more than, I'll say, 30 years old, they weren't built for the power consumption that these EV chargers are going to need to function. So a lot of these communities are going to have to bring in, updated power sources, rework their power, or bring in new dedicated lines in order to service this new generation of EV chargers and e-bikes and all the other things that we enjoy. So again, they weren't built with this in mind, but now they're going to have to adapt. Currently, there are standards for a lot of new construction that require it. There's only a few states that are starting to require it for existing construction, but the marketplace will dictate that as well, right? We work in the rental market here. And yeah, if you want to get, Class A rents in the high rent districts, then yeah, you're going to have an EV charger, right? Those beautiful Gen Zers, they're not going to pay $4,000 a month for an apartment if it doesn't have, EV parking. That's just, their consumer pattern. So the market will dictate what a lot of that drives. But nonetheless, that market is moving that way, whether it be market sources or regulatory requirements or limitations that push it that way. That's the way that it's moving.
And then you mentioned structure here in Southern California. So we have termites here in Southern California. So where would the structure in terms of, say there's termite damage and it needs to be replaced, or would that also come out of the reserves, or do we expect that to be a reserves component from now on?
Yeah, that's prudent to budget for. There are, I'll say, varied methodologies to how you would include it. Our company, Reserve Studies Incorporated, has always just included it as a cycle. Generally speaking, if you talk to pest control operators, they'll tell you in the environment we work in Southern California, about 12 to 15-year cycles. The closer you get to the ocean, the wood's a little softer, the moisture is a little higher. As you get out to the outlying in the desert areas, again, a little drier, so the wood's a little harder, so they're less productive, I'll say. So the high end 15, 16, obviously that will vary by community, but that's the range. So generally speaking, we'll give an allowance to fumigate on those 12 to 15-year cycles. And if you are fumigating a building on a regular cycle, 12 to 15 years per se, then you shouldn't have much additional problems. They're going to come back. They could be back the week after you fumigate, but they'll come back. But if you're fumigating on regular cycles, you're killing them off at a rate that they can't, really colonize and cause a lot of destruction. So if you're fumigating on regular cycles, you shouldn't have any other extensive expenses to deal with your pest or termite control. Other associations, tenting can be inconvenient. So a lot of associations just put money aside to treat as locally as needed, and of course to replace wood as needed, because if you don't fumigate on regular cycles, eventually they're going to get to a section, right? Some rafter overhangs and some other, low-hanging fruit for their perspective. So there's going to be needs out there that you're going to have to spend money on. And so how do you develop a fund for that? So again, a lot of our clients that don't even fumigate on regular cycles use that as a fund to take care of these repairs and these spot treatments, because again, while they may not be frequent, when they do occur, they're severe in a financial impact. A few $1,000s is a small repair. You can get into tens, obviously hundreds of thousands of dollars if you're talking about particular properties. So it's something that you want to have reserved for what's ever appropriate in your community. So I'll say 0 is inappropriate. What might be for your community, talk to a couple experts, talk to your pest control operator and your reserve provider. Obviously, communities that are made of just concrete and steel don't have as many issues with pest control as us wood frame people. So that's another thing to think about. Do you even know what your community is made of? We have a lot of communities that we operate in our market, certainly along the East Coast, that are made of, primarily of concrete and steel, but will have limited wood. So for instance, it's been popular a long time, glulam beams and other wood frame structures for roofing. Here in Southern California and across the Southwest and even much of the Southeast, very popular commercial and industrial are concrete tilt-ups. You see them out there all the time, the industrial complexes that you pass. So these are concrete foundations that they pour, and then they tilt them up and turn them into walls. And that's the perimeter walls for these very inexpensive, very cost effective. However, the roof for those are generally made of glulam beams or some kind of wood timber. And because most of them, again, are glulam beams, they're not real attractive to pests because the glue tastes awful to them. So they're not as subject to. So if you have a concrete tilt-up building, well, you probably don't need to fumigate on regular cycles because they're never going to swarm in because you've got all concrete up until your roof, and so you've eliminated the subterranean termites, and now you just have the swarmers that you would have to deal with. So you killed off half the population capabilities of coming to your property, and then again they either got to get through roofing or other material inside to the interior to get to that wood. Once they get to that wood, well, it's not very tasty. They don't like it. So the chances that you're going to get a major infestation and have significant cost in that particular building are pretty low. But again, you wouldn't know that unless you've got some experience in that level. So if you own in a community association, if you manage a community association, work with your pest provider that will know those specific details about your community, and then work with your reserve analyst to make sure the appropriate amount gets into your budgeting process, whether it's every few years or every few decades. Eventually you're going to have to deal with something in most communities. But again, that will vary greatly by your specifics.
Okay. And what do you think about adding components that are over 30 years old to the reserve study?
I think it's a good idea if you've got some level of predictability, and there are areas where quite frankly you're going to have to make judgment calls. I recently attended the Association of Professional Reserve Analysts. It goes by the APRA acronym, and we had our annual conference that coincides with CAI's annual conference. So we were in Las Vegas, just happened to be there, right? But we got to talking about these kinds of components, understanding that CAI changed its standards in 2023, and we're currently working on updating ours. What about things that are very difficult to predict? As I mentioned, we often talk about piping. We can understand piping because it has a good history behind it. Other things we don't. So as I mentioned, potable piping, okay, reasonably predictable. Gas piping, really hard to do. There are some applications in which waterproofing is reasonably predictable, and other application in which it's not. So generally speaking, when it's on decking and exposed areas, you can kind of give it on the low end of 15, mid-year 2025, but if you've got elements that are outside the building footprint, they're going to be subject to, of course, the heat changes, so thermal expansion. They're going to be exposed to radiation, cold impacting, icing, all that. So eventually, that substrate, the waterproofing, is going to fail. So it's reasonably predictable on those kinds of surfaces. But there are many surfaces, mostly the concrete and tiles, that are designed with drainage systems in place that were quote unquote designed to be lifetime systems that were just, turning out, whose lifetime are we talking? Because after 50, 60 years, all of a sudden, no, that waterproofing isn't there. Some is failing as early as 25 or 30, but there's a lot of, product that's in the 50-year range that has waterproofing in a variety of locations based on, the type of construction that is now just, it's at the end of its life expectancy. And sometimes there's predictability and sometimes there's not. So, at what point can we start including waterproofing as a standard item? And in what, applications can it be included and funded? As I mentioned, I was speaking to some of these other practitioners, and, some of them use, the standard dollar per square foot and other measurements. They have different cost base for not only the square footage of the waterproofing, but also the material that has to come out. In a lot of applications, the waterproofing is in a planter. So now I've got to remove, sometimes tens of thousands of dollars worth of plants so that I can access the waterproofing. Obviously, when I put, the dirt back after, they're going to want plants back. So you have to include those kinds of costs. Well, that cost can vary greatly by community. So again, it's, a very delicate, okay, did we just throw a big number out there and put it out there? Well, no, that's not really prudent. So, don't try and just throw numbers out there to say, yeah, I know eventually you're going to spend some money, but I don't know how much. In an application where you don't know or it's unpredictable, yeah, put the waterproofing in it as 30 plus and say you've got waterproofing in these applications, in planter beds, exposed decking, a lot of the podium decks, but beneath subterranean, garages. Those allowed to have a decking on them, so there's access issues, whether some of it is on common area and some of it is an exclusive use common area. So again, lots of variables involved. So if you want to put it in at 30 plus, no problem anytime. That's always a good idea. Throwing just a ballpark number at it and a ballpark, I think it's going to be this time frame, wouldn't recommend you do that without consulting others. If you've consulted with some professionals, some waterproofing contractors, some roofing contractors, engineers, whatever it takes in the application, then yeah, start using some of their information. So, if an engineer has been out there, a hydrologist or somebody that can give you some good information that a contractor can convert to, man hours, labor, and materials to give you an estimate to put in, then yeah, by all means, fund it at that point. But like I say, don't guess. But that's just one of the things that's going to have to be worked out over the next, I'll say, decade in this industry is, how much of that becomes, quote, standard inclusion and how much of that becomes one-off based on the association. Because a lot of these circumstances that we talk about might just be that. It might be, oh yeah, well, we had to do our planners. Well, that was once in, 75 years of operation as an HOA, and that was 22 years ago kind of number. So, you have to ask yourself, is that something that automatically goes in a reserve study? Or, part of the idea to be robustly funded is there are a lot of things that you can't predict with a great deal of accuracy. However, part of a reserve study's idea is let's reduce our risk. And we're going to talk about insurance in a moment, but that's, part of a reserve study is just risk reduction. So if you fund well to the things that are predictable, again, back to our water heaters and our, our roofing material, things that have a long history and a reasonable life expectancy that you can predict, well, then that's terrific, because if we're funded at a high level for those kinds of items, then the items that we can't predict that just come, I could tell you, different stories, but when I was early in this industry, we had a client got hit by a bark beetle. Yeah, they were in a more rural area, and they owned a lot of trees in this rural environment. And a bark beetle came in and did $500,000, and this is in I'll say 2005 dollars. So yeah, they did $500,000 in damage to this association's trees. I can assure you, there's no reserve analyst that's going to put that kind of a liability as, hey, what could happen? You could get hit by a bark beetle, and and so the other ask is, okay, well, is it going to come back? Well, of course, the bark beetle could come back the next year. That has been over 20 years now. And the bark beetles haven't come back. Thank God, knock on wood for that fine community outside Redlands, California. So they haven't been hit by another bark beetle. So I would call that an anomaly, a one-time thing that by the way, they weren't insured for that. That wasn't an insured, a named item of insurance. So they had to just literally eat that cost themselves as homeowners. But that's something that was predictable. It was uninsurable. It's one of those facts of life, you got to move on. So I think we need to apply, as much importance as we should apply to making sure everything gets included, we should apply equal importance to make sure that nonsense doesn't get added in there as just some, filler like, oh, just in case. Because, if you are budgeting accurately and you have a good inventory, funding well to just in case is going to leave you at a position if something happens that you didn't anticipate. You get hit by a bark beetle. Well, you've got a well-funded, you might have money set aside for roofs that have 20 years, left on them. All right, well, good news, we've got money set aside for these roofs, and we're not going to need it for 20 years. So we're going to spend it today on this bark beetle thing. I'm going to take care of our bark beetle problem. And then now we've got 20 years to catch up and, put our money back into the roof. If you don't have that money to begin with, if you aren't following the advice of your reserve analyst and the other professionals around you, and you didn't have the money set aside for the roof, even though it was 20 days, when you get hit by that bark beetle, well, then you don't have that money. You don't have that set aside. So yeah, you have to endure the special assessment that comes with those anomalies. So as a risk reducer, a form of self-insurance, you can have a robust reserve fund. And then when you get hit by these unpredictable, unknown, uninsurable, catastrophes, you have assets to deal with that. So you are in a much better position to say, oh yeah, we took the money out of reserves, we dealt with this terrible bark beetle problem, and then now we can recover the reserves over time because it was set aside for longer term assets. Thank God. Not a pleasant thing. You're not happy you went through it, but you managed your way through. Without that robust reserve fund, without that reserve study to know how much to have in that reserve fund, you would get hit with that and have no other choice but to special assess the members at the time, which again, it was several $1,000s per member that they would have had to come up with to deal with it appropriateness. So again, a reserve study is a good risk reducer just by giving you assets to deal with the things that nobody can predict with any level of accuracy.
And you just spoke of the consequences of getting your or being underfunded on the reserves, or getting the reserves number drastically low, being underfinanced, and the consequences of that, a special assessment. And can you speak about special assessments?
Sure. They are unfortunately widely used because in many jurisdictions, they're easy to do. Again, I don't have any CAI immediate data, but I'm sure if you pooled the industry, you would find that few states, I'll say less than 10, have high level restrictions on special assessments. So I'll just give you some that I'm familiar with. In California, a homeowners association, the board does not have the authority to assess its members that greater than 5% of the total budget as a special assessment. And they can't increase the regular assessments, the gross budget again, by more than 20%. Now, to go above that, they can have the membership approve it. So if the majority of members say, yeah, up at 25% and, special assesses, 10%, then that's perfectly fine. But as far as the board doing it on their own, that authority is limited. Other states have similar limitations on that. So many associations in California, would have to violate that in order to get the money necessary. Just on the flip side, as a comparison, commercial associations in California have no such limitation. So if you own a commercial association and they special assess you, they can do any amount at any time and just say, here, send me the money. So a vast difference between owning a home and owning a business condominium here in California. So that same thing will apply in many states. If there are no limitations, then yes, the board is free to assess however much is necessary at whatever time frame necessary to meet their obligations, because again, their first obligation is the association. So hypothetically, if you've got a roof problem and it's going to cause secondary or consequential damages and or bring a life-threatening issue, then no, you have no choice but to do it right now. So if that choice is, well, the roofers don't work for free, so we have a fiduciary duty to maintain this structure and to keep this roof from causing further damage. So now we're going to special assess the entire membership. Remember, it could be 9 buildings and only one of them needs the roof, but all 9 are going to, serve in that special assessment. And now we're going to special assess whatever's necessary to deal with that problem. Sometimes it's only a few $100s per unit. Sometimes it's several $1,000s a unit. As a matter of fact, to go on that note, in 2023, FHA changed its guidelines. So now FHA, as a disqualifier among many, and they have many products and of course many disqualifiers for each, but some of their general disqualifiers. One of them is now $10,000 per unit of what they would call accumulated depreciation or underfunding. So if your association and your portion of it is $10,000 or more underwater, they're not going to give you an FHA loan. And that may sound, not like much, but those are tens of thousands of loans a year that are done by FHA, because these are not only resale loans. This is not only to acquire property, this is also to use your equity. So if, you're a veteran and you want to take advantage of one of the many VA loans out there, same requirements are going to apply. If you want to use many of their, home equity loans to send your kid to college or redo your kitchen, same rules are going to apply. So there will be many people who get surprised at the condition of their HOA. But FHA, just like everybody else, like the insurance industry and others, they have to mitigate their risk. They have a responsibility to their, interest holders. So they instituted some risk management procedures, and one of those was to require at least $10,000, because generally speaking, when you're talking about the FHA level housing and so forth that it's used for, $10,000 would impact your capabilities to make a payment, right? You may or may not have that liquid, so that $10,000 can be devastating to a lot of community associate owners. So, if you own a $5 million home on the coast, well, then no, that's not really the target with that particular requirement. But yeah, if your association is such that you're lending to buyers that a $10,000 special assessment would be problematic to their ownership situation, then yeah, FHA is now no longer a loan on those properties located within them. So we see this all over the market. As I mentioned, we talked about insurance, but homeowners themselves are taking these opportunities to reduce their risk because it's ever growing.
What are homeowners doing to reduce their risk?
Well, the first thing they're starting to do is read and understand the documents that they're getting, and then get below those thresholds. As I mentioned, FHA, and again, I encourage anybody to participate in CAI and the Foundation for Community Association Research, but it was upwards of 70% of condominium loans are FHA of some form. Again, in the higher end markets that go well above the $750,000 level for FHA financing, no. So yeah, in a lot of communities, no, FHA is not a big thing, but in most of rural America and many parts of suburban America, FHA is the primary lender for condominium associations. So it has a tremendous impact. So, for instance, one of their requirements has to do with non-owner occupied. So if you get too many rentals, if you get above their percentages, well, then now you can't get another loan in that property. So if you wanted to sell your unit, well, I can't use FHA financing. So either you have to, sell it to somebody who isn't using FHA financing, which means private lending, which generally means different terms, usually a point or two higher. Then they're not going to be as willing and or capable of paying you as much for your property because they get different loan terms. And generally speaking, and this is true all over the board, most people buy as much home as they can afford. So until you generally get to the billionaire class, they're buying as much home as they can afford. So, if hypothetically I could afford a $4,000 a month payment, okay, great. Oh, all of a sudden I got $500 worth of HOA assessments coming. Well, now I can no longer afford $4,000 a month. I can afford $3,500 a month. And so that goes at every level. So until you get to the, literally the multi-million-dollar homes, the amount of assessments that you pay have an absolute impact on it. So there are many associations that their requirement to fund themselves has been undergauged for years, and so they're underfunded. So we understand that reserves make up a portion of a budget. In some circumstances, it's a small percent, 3 or 4%. In a high circumstance, it might be 20, 25%. It rarely goes over 30. But in most circumstances, we'll just use, 10 to 15%. So whatever dollar you're collecting, well, most of that is going for your HOA insurance. If you have professional management, you're paying for, legal and financial services. You've got utilities. So most of the dollar that you bring in is already earmarked for these services. So in any circumstance, when you're bringing in money, okay, some of that's got to go to future endeavors, our roofs, our plumbing, our asphalt, whatever it may be. But it's, again, broad numbers, 10 to 15%. If you for years are not doing that, you're just not setting the money aside. Okay, so we'll fast forward, say I'm a 30-year-old property now. I've got a lot of deterioration. I've got just standard aging, right? I'm starting to look tired. So you've got not only the infrastructure, I've got 30-year-old plumbing. It's only got 20 years left, right? I got 35-year-old roofing, and oh my goodness, it's only got a half a dozen years left. So you find yourselves needing a lot of cash, and you just simply haven't gotten that because you haven't funded for those 30 years. Well, now you have no choice, right? Either you got to special assess and say, hey, look, we need all this money for this roofing and plumbing, whatever we got, or you have to increase the regular assessments sufficient to bring the money in, right? And if you do that, well, now you're going to go outside the market because remember, you don't have control how much the landscaper charge, right? The landscaper charge what the market will bear. And so you're going to pay whatever the market is for landscaping. You're going to pay whatever the market is for your water and utilities. You're going to pay whatever the market is for management and maintenance services, and you're going to pay those, right? Because if you don't pay those, then, they turn off your water, they stop, mowing your grass. So those are always going to get paid, and they make up the bigger portion of your budget. So now if you're an older community and you're, significantly underfunded, well, now you would need to increase your assessments. Okay. All right. Well, we know that 70 cents, 80 cents on the dollar for sure, probably closer to 90 cents on the dollar is going to the operating. Well, that hasn't changed. So now that 10% of budget. So if I had to put $1, okay, well, now I got to be putting $2 or $3, because I got to play catch up. I don't have any money. And where's that going to go? Well, it has to go on top of the operating. So now I'm out of budget, remember, because all the other all the other homes in the area that are in good run HOAs, remember, they have a sufficient reserve fund. So they're still collecting the dollar. If you're collecting $10, okay, we're going to take our dollar and put it in reserves. They're still doing that. So they don't have to collect any more than the $10. They got $9 of operating and $1 of reserves. They're doing just fine. You, on the other hand, you got $9 worth of operating. That's the way the world works. You can't change that. And now you need $3 or $4, right? And so you have no choice but to get into $13, $14 because you have to pay, your reserve fund because it's been underfunded for so long. So now your community at $13 or $14 is not as attractive as the one at $10. So that's going to be a problem because, again, I'm using numbers I can do in my head. When you're talking about buying the average home in California, just hit $900,000. I know there are many communities on the East Coast and the Midwest, and certainly the Southwest, that they have, multi-million-dollar communities that every home in there is worth multiple millions of dollars. So it's really starting to impact their capabilities. So if you're just in an average community buying a $500,000 home, if you have to now have 10, 20% of your budget be going to underfunded, forget what we're putting away for tomorrow. This is just trying to catch up to where we are. Well, then, yeah, you're not going to be competitive. So you're going to suffer that in the marketplace. Your home is not going to be as worth as much as other communities. And again, if it gets into a drastic condition, again, using FHA numbers, they don't loan on less than 10%. So if you're not putting 10% of your funds away or you're less than 10% funded, there's a high likelihood you're not going to get anywhere near an FHA loan. So again, you're going to have to go to the marketplace, accept whatever terms are coming your way, which are going to be half a point, it'll depend on the market, but certainly they're going to be higher. And that's going to result in a higher payment, which means that, you're not going to be able to offer as much for that house because, again, most people are buying as much home as they can afford. So they talk to their financial advisor and the real estate agent. They say, yeah, I can afford my, $800,000 home and my $3,700 payment. That's what I can do based on my down payment. And if those numbers change, okay, well, the numbers change, but most people don't change their down payment in a significant way, right? I mean, if you have 50,000, if you have 100, if you just sold your home and you're sitting there with $500,000, it doesn't change. So the other circumstances that will change, of course, not your income, right? Did you get a better job yesterday? Did you get a huge bonus? No. Okay. Your income's still that variable. Your cash is still that variable. What's the other variable? Oh, well, the loan, its terms, and oh, by the way, how much I'm willing to pay for your home. So understand that variable is going to get used in the transaction process because you're going to be a disadvantage over others in that same environment.
Okay. And how long do you think of underfunding it? It probably takes years of neglect towards funding to get to a point that it really turns bad.
Yeah, I'll say you generally have a good decade. We rarely see circumstances where a less than 10-year-old building doesn't have sufficient funds. Using the numbers here, I'll look just to see you here. 24 states require a public offering of the finances in order to sell a condominium. So, again, nearly half, just under half of our states have recognized the need to get this from day one. Obviously, the other 26 will do what they do, but generally speaking, in all of the states, 10 years, you should expect that your reserve expenses are not gross. right? Are not going to, and all of your major infrastructure items, asphalt replacement, your roofing replacement, any plumbing replacement, all that kind of stuff is generally more than most of your mechanical equipment, your big, HVAC operations, all of that, more than 10 years. So you should not expect big expenses. So depending on how you're funding yourself during that 10-year process, you probably shouldn't expect any special assessments or added needs. That 10 to 20 year, that starts to make a difference. That's when you'll start to, I'll use the phrase nickel and dime it, right? By 10 years old, certainly you got to deal with some painting cycles, right? You probably got, carpeting, flooring, other aesthetic related issues. You might have small fixtures, other things starting to come into play. By, 15 to 20 years, you start talking about, all of your water heating equipment, your small furnaces, air handlers, that kind of equipment. So, as you age from that 10, 20, by the time you're 30, it's too late, right? If you haven't been funding by the time you're 30, you're going to be in a drastic situation.
Wow.
So, yes, I'll say that you have a 10 to 20 year window in which to correct a mistake. In the 26 states that don't have a public offering, we'll just say, oh, they got off on the wrong foot. So in those 26 states, you got yourself a good 10-year runway, maybe up to 20, but you certainly don't have more than 20 years because, if you're underfunded for 20 years, you're significantly underfunded. As I mentioned, and I may have talked about it in another program, going back to my other rant of just a moment ago, let's use that $10. Let's say my assessments are $10 a month. Well, we know what happens every year is inflation, right? In the last few years, we've had some, historic inflation, 3, 6, 7, 9%, right? And it varies by product, right? You have some things that inflated, 300% and other things that inflated 4%. So it's been difficult to capture and put into forecasting. But nonetheless, we've had significant inflation. So if you've got, your $10 a month that you're putting aside, okay, well, you have inflation that you need to add to that. So maybe next year it goes from 10 to 11 or whatever your numbers are. Well, we have this mentality in the association world. Everyone likes to, brag about, when I was president, we never raised the dues, right? They say this with some kind of pride, like they've, taken in inflation over the last 3,000 years and stood it on its head the 6 years that they happen to, reside over that HOA. So no, they just didn't fund it, is what they're telling you, right? So during that period of time, you have no choice. Again, your landscaper, all these are market rate things that if you don't pay, get canceled. If you don't pay your insurance, they will cancel you. It's that simple. So you pay your insurance, you pay all these bills. And since they make up 80 to 90% of every dollar you bring in, most of the money you bring in is for those ongoing expenses. So, you're going to get yourself in that same kind of trap where you don't have enough money to deal with it. So if you don't raise your assessments, you know what happens? You pay your regular assessments and you stop paying your reserve fund. So out of that $10, let's say that you put $1. Okay, well, get what? The next year, you're going to put what, like 70 cents, and the year after that, like 50 cents, because, that HOA's got to go up from 10. It should be collecting 10, 50, 11, $12, whatever it may be, but it stays at 10. And its operating budget, again, starts at $8 and then it goes to $8.50 and $9 and $9.50. So again, by 4 or 5 years of this kind of pattern, you've probably erased any difference between your reserve contribution and your operating budget. Now you're forced to increase your assessments because now your income that like, oh, wow, our operating budget's more than $10. That wasn't the case a few years ago. Now we got to bring, now it's $11 just to operate this place without putting the $3 now that you should be putting into reserves. So, they're going to get themselves into that same trap. So, pay attention to what your advisors are telling you, management, CPA, your reserve advisor. Follow their advice because, you're going to pay one way or the other. It's your place, it's your house, it's your money. So whether they collect it in $1 a month or whatever sequence, or they hit you up for several $1,000s every, year or every few years, depending on the circumstances, you're the one who's going to pay. You own, 1/100th. If you live in a 100-unit HOA, you own 100 of that, and you're going to pay the appropriate amount. Again, many people now live in what they would call variables. So if you live at a big suite, you'll pay $1.25 of the assessment, and somebody who lives in a smaller unit might pay 75 cents of that same quote dollar assessment. But nonetheless, one way or the other, no matter how it's calculated, it's your money, it's your association. You live there, you're part of it. It's all of your cash, so you will pay your appropriate amount. So you're really better off by well funding yourself. We talked about insurance companies are now using this as part of their criteria to the evaluation, because again, understand, insurance has a pretty simple job. In essence, they sell risk, right? They sell you an insurance policy and they take your risk. So whether it's your car, your life, your house, the chances of you losing any of those as X. They have calculators that give them the accrual rates, and they make their estimate, and that's based on their I'm taking that risk on. And then of course they have cost, right? People pass away, they have to pay that life insurance. People crash cars, they got to repair the cars. And of course people's homes get damaged, they got to repair the homes. So they are, in essence, they're selling the risk that they take on, and they have to manage their cost. So what's happened to them, of course, is that their risks have increased and their costs have. Just on the cost, we'll talk real quick about car insurance. Everybody's car insurance has increased. Well, there's a few reasons for that. One, cars have increased, right? The cost to replace the car is higher now. Now everything is electronic. It used to be you'd have a fender bender. We bang up to, okay, we'll just repair the fender. Well, now you got to repair the fender, and then you got to call on a computer scientist to recalibrate, the 19 different sensors and cameras that this car has, So things are just more complex. So now there's no such thing as a cheap auto repair. Every auto repair is a few $1,000s. You can check with Auto Club, any of these, that keeps the statistics. But the cost of repair, the average cost of repair, continues to climb. So insurance, of course, is putting this out in premium. So that's why your premiums are increasing, because the cost of cars, the cost of repairing cars is going up. So apply the same thing to housing. It's not a secret why the two worst insurance markets right now are Florida and California. Why? Because those are the areas where climate change is having the biggest impact. Remember, when we talk about population, we're talking obviously California, you got Texas, Florida, Illinois, we'll throw in New York and New Jersey and some of those. But, when you're talking about the biggies, obviously California is there, Texas and Florida are the ones that people talk about, because their populations are so big. And so when it affects them, it affects just a higher number of people. Well, they haven't been able to make any profit in Florida because they haven't been able to accurately predict what's going on. They know they've got issues, and it's not just to Florida. I mean, there are issues, in the coastal Carolinas. There are issues all along the Gulf, the East Coast. So there are parts of New Jersey, Pennsylvania, Virginia, West Virginia. The rivers are rising, they're starting to come up into homes. So it's not isolated to any one part of the country. There's just different areas that are suffering from these consequences. Louisiana, a classic case. So the insurers are having a hard time predicting these costs because they don't equate to anything in the past. Same thing's happening in California. In California, they have a requirement that their costs are based on their experience, not their predictions. So of course, these insurers, they hire a lot of actuarials. They're sitting in offices, they're crunching numbers, trying to come up with it to say, all right, we know what we've spent in the past. Okay, that's just bean counter stuff, right? That's easy math. We know what we spent, but what are we going to spend in the future? What's going to happen to homes? And they do that based on old models of where fires used to hit and how frequently they used to hit. Well, throw those models away. Go all the way back to the mid 2000s. But certainly, by the time I think 2018 was the deadliest year. But if you go back for the last 50 to 100 years, where they've been keeping records on forest fires in California, the top 5, most of them are within the last 5 years, and in the top 10, a majority of them are within the last 10 years. So certainly, it doesn't take a genius to tell you that the frequency and the severity of California fires is different now. It just is. So, to pinpoint any precision on that, that's not my area of expertise. And unfortunately, the insurance company hasn't been able to use whatever they have come up with. So whatever they've said, oh, I think this is what's going to happen, they're still isolated to, well, what have it cost you? So yeah, they put the Camp Fire and all these other tragedies into there. This is what we paid, $2 billion here, $4 billion there, all that cost. So they can put that into their costing, but they can't use that as a predictor. That's why so many of them are leaving the state. They're just saying, hey, that's just unpredictable. We have pockets here in California where it's just becoming more and more challenging to get insurance on homeowners. So, whether you're in an HOA or just a single family dwelling, or you own an apartment building, you're looking for renter's insurance, or you own the apartment building and you're looking for, property owner's insurance. There's just, I'll say, a retrenchment in the insurance industry. So, I talk to a lot of small business people and I tell them, so, if you were doing, 500 jobs a year, whatever it is you do, let's say you do 500 a year, and they told you, oh, well, we need you to cut 20%, so that's 100. Well, I'm sure that the first 50 are like, oh, that guy's an old crap. I'm tired of working with him. And oh, that complainer. Yeah. So some of those cuts are going to be fine. Let's all admit that as business people and as employees. There's just some clients you're like, I'd be better off if they weren't around. But then after that, it's just like, oh, I like that guy. He was pretty cool. Or, oh, that lady was nice. She was always cool to work with. Why? Well, oh, well, we're cutting 20%. So that's an arbitrary number, right? So you did 500 last year. Well, now you're doing 400. That's just the way it is, because that's their re-entrenchment. They're just like, it's got too much risk. We can't accurately predict that. So we're just going to write less policies. And when you're talking about the major carriers out there, you're talking, in some cases, some of these people have tens of thousands of policies. I think in the larger carriers, they could have hundreds of thousands of policies in the state. So you are literally talking about hundreds of thousands of residents now that are either being impacted directly with these higher premiums, but literally tens of thousands of people who are just losing their insurance altogether and forced to go into this turbulent environment with, oh yeah, XYZ canceled me and I'd like insurance, please. So, yes, you're going to get a premium increase. That's just natural, right? But, finding the insurance now, so there's quote unquote a lot of underinsuring. So if, you, again, add up your assets and your requirements and say, oh, you know what, we should have $50 million worth of coverage. And the carrier says, well, I'm only going to offer you 30. Well, instead of walking away or looking for a different carrier, they'll say, well, I'll take the 30. And so now the independent, the property owner, whether it's the HOA or, commercial owner, rep, whatever you want to call it, whoever's making the decisions, they say, hey, yeah, insurance is just unreal. I could only get $30 million and it's got a terrible deductible, much higher, 3 times my previous deductible, but I'm going to take that because that's the only thing in the market. Well, okay, fine. You've got your increased operating, right, with that premium increase, but now you yourself as a property owner have taken on $20 million worth of risk. I was recently listening to a gentleman named Kevin Davis, who's an insurer nationwide. He happens to be located here in California. And he was saying there was, over $1 billion worth of uninsured property out there because people are either choosing to underinsure for cost or because they can't get the coverage and they don't want to go out to the market and pay the premiums that it would take to get proper coverage. So there's a lot of that going on. So again, back to my earlier point before this rant, that's one of the tools that the insurance companies are using to get rid of clients. Because again, go back to the tragedy of Champaign Towers, which woke up the entire country. A lot of these issues, a lot of the changes, it's not a surprise that CAI changed its reserve study standards, 2 years after Champaign Towers, because that woke up the world, because that is the classic case of kicking the can down the road. As I'm sure most of your listeners are aware, there was an association and they knew they had a lot of issues. It was an older community on the coast and they, kind of didn't deal with it. They let it go. And then the money increased. And so they let it go a little bit. And so by the time they got around to starting to work on the problem, the price of the property ballooned, like tripled. And then, of course, it ended with 98 lives. So we all hear the stories of Champaign Towers. And so there's a lot of repercussions from that, both in the lending world and in the insurance world. So part of what the insurance industry is looking at now is, are you a prudent HOA? And I got to tell you, I've been doing this for a long time. If an HOA today of almost any size, I mean, if you're a small little 8-unit HOA, okay, maybe you got some good cousin, friend, or uncle that can give you an idea what's going on. But, if you have 400 units and you don't have a professional reserve study, I got to tell you, you're high risk. Right. I mean, that's just a good product to have. It'd be the same as telling me, yeah, we don't have professional management. Or my cousin Bob, he does the books. Well, does he do them for any other HOA? No, just himself and his bakery. No, that's not who you get to do your books. So, if you're an HOA, you're a corporation, and you should act responsibly. So if you're telling me that you're a corporation today, an HOA of any significance, and you don't have a reserve study, 2 years, 5 years, you can argue over the age of it. But if you're not getting regular reserve study updates on a regular basis, you're not protecting your interest holders. You're not, preparing for the future. So you're not doing them any favors by, quote, saving the money. No, you're lacking the critical information that it takes to make these long-term financial decisions. And so as an insurer, well, who am I going to cut first? Well, these people, they've already proved to me, in many cases, you're breaking the law. We already know that, in certainly 12 states, you're breaking the law. And, in others, you're breaking all prudency. So, yeah, if I was an insurer looking to cut 20% of the people out there, well, what an easy low-hanging fruit for me, because, yeah, these are the people that prove to be the problematics, right? I do seminars for real estate agents and others, and I'll tell this story. I'll say, if you want to know about an HOA, drive through. If you see a nice HOA, right, the things are painted, it's well maintained, it looks like a well maintained community. Well, now you're going to spend a lot of time looking over the finances of that community to make sure that it's properly funding both its operating needs. Pretty apparent, right? It wouldn't look good if it wasn't funding its operating needs, and right, they wouldn't have insurance, all those other things they cancel. Okay, I'm pretty good with that. I'm comfortable. Now let's get the reserves. I'd want to see their percent funded, their status, their funding plan, all of that. Okay, now if you're driving around looking at real estate and you pull into a community and it's got deferred maintenance, like, it hasn't been painted in a long time, you see peeling paint on the wood and the metal, it's got rust coming through, the asphalt's all old and cracked, everything, they're broke, okay? Because there's never been an HOA that I've ever seen that has money in the bank and a terrible appearance, right? If they had the money, they'd paint their building. If they had the money, they would repave their asphalt. If they had the money, they'd replace their light fixtures, right? They would do that. So if it has got a lot of visually deferred maintenance, I can tell you they're broke, because nobody allows their property to look like that when they got a bank account that's full. So yeah, that community is broke. So yeah, probably best be driving on, because your assessments are absolutely going to go up, and you might be looking at a special assessment in the near midterm, depending on some things. So yeah, if that's the only property around, then yeah, I guess take a closer look. But remember the risk that comes with that, because even with all that information, there's still risk, right? So if you've got a property that has much deferred maintenance, well, eventually they're going to rip that roof off and replace it, and guess what they're going to find? They're going to find deterioration that wasn't visible, and that's going to add to the cost to replace that roof. So if you see a property that's had, years of deterioration and deferred maintenance, well, you can pretty much guarantee there's going to be corrective maintenance once they get to that regular maintenance that they overlook or deferred.
And that's a huge point. And, you spoke about in our last podcast how an HOA is a business. And when you join an HOA, you're joining a business. So you don't want to join a business that's broke and you're going to have to pay for it when it's at its worst point and bring it up. And one of the best ways to be aware before you join that business, before you join that HOA, is to do that property inspection and really look around at what their their common assets, their reserve components look like.
Yes, the prudent thing is to make sure that you know what your anticipated expenditures are, knowing that you can't predict everything, but if you're well prepared, you can deal with the unexpected. So to prepare for that, because it's going to come, and in the commercial world, they call it a capital call. In the HOA world, they call it a special assessment, but it's the same thing. Give me lots of money now. And so you need to protect yourselves from that. If you're independently wealthy, that's fine, but that can be problematic too. Going back a few years during the pandemic, of course, everything shut down. So Major League Baseball had to do what's called a capital call to the owners. So the owners of the Major League Baseball teams, they had to put money into the MLB in order to fund the operations, because of course they weren't selling tickets and they weren't broadcasting games, et cetera, et cetera. So, while, I'm not going to cry for the wealthy billionaire owners of the MLB, they nonetheless, during tough times, they had to send some money to maintain their operation. So it's the same thing for homeowners. If you're out there with a piece of real estate, whether it's just a few $100,000 or even a few $1 million, you could get hit with these special assessments. And that means, send us money now. If you're, again, commercial condominiums are becoming very popular out there. So if you're a small business entity and you're considering investing in that, terrific. They're great investments. But you need to look at the paperwork to make sure that it's a well-run community and that you're, investing because, to your point, you own whatever percentage. So if it's 165th, then it's 165th. And you got to start doing the math on what your 165th means, both in an operating contribution and what your potential liability is for these long-term capital expenses, which, again, depending on the property, can be, tens of thousands, possibly hundreds of thousands of dollars.
Okay. And you mentioned at the beginning of this podcast that when people purchase a home, they purchase the highest quality, the largest price point that they can in their home.
Yes.
And they might, hopefully they're taking their HOA fees, their property, everything, their mortgage into account. And then you speak about being prudent and actually looking into the HOA's quality, how the fixtures, how's the landscaping, how's the paint, how, does everything look like it's been being maintained properly. And then on top of that, we spoke about, how well funded is the reserves, what percent funded, are they actually doing their reserves study as they should be? And also, these insurance people going in underinsured with their property, deciding, okay, we can only get so much insurance. And so you mentioned $1 billion by Kevin Davis mentioned underinsured. How is this all? What do you think about this? And then what do you think about it?
Well, I think there's going to be a lot of surprise when the market comes back. Remember, interest rates are high historically, recent history at least. So interest rates are high from recent history. So transactions are at all-time lows for continuing. Obviously, there's been many dips in real estate, so the number of transactions has been below what it is right now. But right now, we're at historically low transactions. There's not a robust market. So real estate is very limited right now because of that. The industry behind it, both mortgage and insurance, which drives a lot of it. I mean, how many people are buying cash houses, right? So most of the people are buying money with a mortgage, so they get the scrutiny that the financial industry is placing upon these. And of course, the finance company is going to require that you have certain insurances, and so the insurance companies are applying their standards. So when we talk about the industry out there, the millions of homes that transfer every year. Again, CAI anticipated upwards of 78% of all new construction is within an HOA. So it impacts a lot more than it used to, right? The number of HOAs being sold is still higher today than it was in 1970. Even, of course, the number of transactions right now is lower than it was in the 1970s. When that changes, when rates come down and activity returns to normal, whatever new normal is, but when purchase activity goes up, and you start seeing a lot more escrows fail because the HOA doesn't meet the criteria, that's when you're going to see a lot more consternation in the market. And that's when you're going to have what I will brazenly call the unsaleable HOA.
Wow.
So if you are in an HOA that gets caught, well beyond that line, and that line is movable, but again, if you are in single digits for your funding, right? If you have less than 10 cents for every dollar you should have, you've probably got a special assessment in your future. And not only do you have a special assessment in your future, you've probably got some significant increases to your operating income. And there will be very few finance or insurance companies that want to touch an HOA like that. Right? It is like we don't want to we don't want to loan somebody to buy into that HOA, and we don't want to insure somebody buying into that HOA, and we certainly don't want to loan directly or insure directly that HOA. So they've got the challenge of the HOA, and then they're buying into that HOA. So once an HOA has finance and insurance saying, well, we don't want people in there. Well, if you own already, if you're one of the unfortunate that already own in that HOA, what are you going to do? Right? You're going to become an unwanted landlord, or you're going to sell for pennies on the dollar. So wow. Yeah, if you get that, that job promotion, that transfer, you get married, graduate college, high school, whatever, there are a lot of things that determine why somebody moves. So all those life occurrences are still going to occur. So you're going to have to make the decision. Well, gee, I'd really like to take that promotion, but I'd have to sell my unit. Oh, and I can't do that. So either you sell at a discount, based, on its circumstances in the market, or you become the unwanted renter. You say, oh, well, I'll keep the unit and I'll rent it out to help cover that mortgage. But yeah, I can't sell it because, again, you'd be looking for a cash buyer. Most of the people that are capable of buying cash would recognize the circumstances. And so now we're back to the underpriced offer. So you can sell that asset, again, whatever the market will bear. It might be only at 10%. It could be a 20. It could be a greater amount of loss that you get on the value of that unit because it's unsaleable by, what we would call conventional financing. That would all vary by circumstance. But yeah, if you want to unload it, you're going to pay a price to unload it. If you can't unload it, then yeah, you're going to have to take circumstances into your own hands. And, unless you want to have that property sit vacant and the cost, just be a negative onto your own private books, no, you're going to rent that out as best you can. And again, some people, live in communities that have rental restrictions. So, if you're at the cap of that, well, then yeah, you can't do that. Some of them have exceptions for family members, et cetera. So you might be able to get some workarounds, but no, there could be more and more limitations to your asset. So yeah, those properties that are significantly underfunded are going to feel it much harder in the next 5 years than they have in the past 5 years, and certainly more in the next 10 years than they have in the past 10 years.
Wow. And have you seen that occurrence happen where an HOA becomes, what was that term you used?
Unsaleable by
Unsaleable.
conventional terms. Yeah. Nobody's willing to purchase in it under terms they can afford. Because again, that, once you cross that paradigm, if hypothetically I'm in a community that homes sell for $500,000 and, the average payment's $2,500 and our assessments are $500, okay, that all math works. Oh, well, ours is $1,000. Well, now that just throws all that computation out. So it no longer works. So in almost every environment, you're going to have a better choice outside that HOA, right? You're going to find a home that is similar value, similar benefits, and my payment's going to be $500 less per month, or it's at the level I want, so I'm only willing to offer you, $420,000. That's it. The way the math works for me, I can't pay $500 for your house because of these numbers, so I can only pay $420. So again, one way or the other, the owner of that real estate is going to be impacted by the devaluation of their asset. Because again, one way or the other, whether you have a massive special assessment to get out of it and you're well funded and like, oh, good news, now we're well funded, we can keep at market rate for our regular assessments. Okay, well, you had to pay the big special assessment to get there. Or, oh no, we're going to sell with this tragic underfunding and we're going to go into a market that obviously in many states, 32 now, that have the disclosures that, of our circumstance. So you're just going to be, again, disadvantaged by the fact that, you're underfunded and, they're going to have probably better options. There are unique circumstances, but in most cases, they're just simply going to have a better option. So it's going to be very difficult to move those under conventional financing. So back to the earlier point, yeah, you'll still be able to move it, but it's high risk financing. You're going to pay the premium. So you're going to pay a point or two higher, which means your rate goes up, which means your payment goes up. And again, if you're buying as much home as you can afford, means that you can't pay as much for that house. So, they're going to get you one way or the other. There's almost no escaping the fact that you're underfunded if you're using, loan dollars, if you're using financial industry dollars. And again, back to, okay, there are people out there that are paying cash for real estate, terrific, but most of those are fairly sophisticated and would take that your considerations into account when making an offer. I certainly wouldn't pay full price for a property that I knew was subject to one or more special assessment. I'd want a discount on my real estate for absorbing that risk.
It seems like everything is coming together in a pretty tumultuous way.
Yes, I don't get invited to parties because I'm such a naysayer, but we're coming on a very expensive time. This inflation that we've experienced, good news, it's under control now by most common standards. And by the way, I get this question a lot. We've had some terrible inflation. Obviously, we had the 1 year with 9. So yes, if you look back, since the pandemic, certainly inflation has been an issue. But the current 30-year average of the inflation rate is still like at 2.5. I think it's 2.54, but it's like 2.5. So it's still 2.5%. So part of that is driven, like, remember that in the 12 to 15 years leading up to the pandemic, we had historically low inflation. We had several years that inflation was below our target 2%. And it had been 20 years since we had had any kind of inflation. And you literally have to go back to the 80s to have what we would call problematic inflation. So we had gone a long period of time without inflation, and now inflation came back. Good news, it's now, we got it under control. Raising those rates, it's certainly not comfortable. As I mentioned, it really killed the housing market. It's at all-time low. So there was some cost to raising those rates economically, but it had to stop. And we could not afford 9% inflation on any long-term scale. That's too problematic. So the long-term inflation right now, 30-year, is 2.5. That's pretty consistent what it's been. If you took 30 years ago, you took a 30-year average, it's probably close to that. 30 years from now, you take a 30-year average, it's probably going to be pretty close to that. The challenge is those costs are already there. So what used to cost $1,000 a couple of years ago, well, it's $1,300 now. It is what it is, and it's not going down from that 13. So we will feel the economic impact to these higher prices as we start to experience costs. So as we replace our water heaters and our furnaces and our roofing and our asphalt, we'll continue to see that. Another thing that's exacerbating the HOA issue financially is HOAs, of course, a lot of their spending is regulated to services. So whether it's financial services like the ones that we offer, legal services, accounting, professional management, contracting services, maintenance services, janitorial services, it's all driven by services. As you know, minimum wage has increased in many markets. So that increases a wide spectrum of their spending. We get into these discussions, most of our customers would be delighted to know that they're spending less than a percentage point, right? If you ask, well, how much is my fee versus how much do you guys, bring in revenue? Oh, it's 0.003%. It's a really small number. Whereas your landscaper can take up 20%. You can spend 20, 30% of your income on insurance, depending on the property, So we make up a small percentage, but these large percentages start to add up for a while. So getting back to the minimum wage, one of the big expenses for HOAs is, of course, landscape and janitorial. So those have been, typically hit very hard by these minimum wage. Speaking specifically of California, between I think it was 2015 to around 2020, we had a 47% increase to our minimum wage overall. That's not talking about this recent fast food thing. This is just our overall. We went from it was $14, $15 an hour up to $17, $18 an hour. So we increased our costs significantly. Oh, well, if 30% of your budget is a landscape contract, well, now it's going to go up. So if it goes up 10%, you don't have to increase your budget 10%, but you got to increase it a few percentage points. So these services now are getting expensive. So I mentioned that we have the low cost labor, the entry level labor cost, but we also have the higher level cost. And three specific industries that we deal with a lot in the HOAs, the attrition rate is much greater than the entry rate, meaning more people are leaving the industry or retiring than are doing it. Unfortunately, for the last 20 years, everybody that graduates college is told they need to be a coder, right? So nobody bangs roofs, nobody wants to work on plumbing, and there are no elevator mechanics. So if you own an elevator in your HOA, be prepared to pay higher costs because the attrition rate amongst certified elevator operators is much greater than the entry rate to people into the profession. If your HOA owns a roof, again, be prepared because the attrition rate is greater than the entry rate. And if your HOA owns any amount of plumbing, including pipes and water heaters and other devices, again, those costs are far exceeding inflation because now companies are having to pay a greater amount to the remaining workforce that is out there. So good news for all you plumbers and roofers and elevator technicians out there. You're making more money now. You're beating inflation because your service is in demand because, again, just simple supply and demand economics. But if you're on the HOA side and you're paying roofers, plumbers, and mechanical engineers or others, unfortunately, that's going to be impacted. So while I think most of us can expect moderate inflation in the midterm. And, long term, anything can happen. But in the midterm, yeah, low 2.5, even 3 is not the end of the world. We could survive 2.8 for several years in a row and not go crazy, right? We've done that in the past. So I think standard inflation for your day-to-day, groceries, household goods, etc., is going to be relatively moderated. Unfortunately, if you live at an HOA, you're not going to be limited to those. We're going to outpace inflation. Again, because so many of our costs are associated with services versus products. Most of the products, unfortunately, reflect a standard inflation cost. So it's difficult to get services into that. So we're just going to pay, again, hypothetically, if inflation is 2.5, well, expect to pay 3.5. We're not going to pay 5% more than inflation, but yeah, we can expect a couple of points higher than inflation. So whatever inflation is over the next 3 to 5 years, expect your association's costs to go up higher than that. If it's underfunded to start with, well, then, again, all bets are off. It could go up significantly based on your starting point. Again, I'll plug our services. If you're thinking about buying real estate, don't buy without a reserve study. Because that is a very risky proposition in today's market. It's always been a risky proposition, but in today's market, it is especially risky to be investing in real estate without some kind of outline of its financial picture.
And your company, Scott Reserve Studies Incorporated, where do they serve?
We service all of the West Coast. ReserveStudiesIncorporated.com is our email. 800 number there on our website. You can call us, email us, but we service the Western United States. We've been servicing California regularly for 34 years now. We've been doing it. Our office is located in beautiful Cerritos, California, which is right between the LA and Orange County border. So most of our clients come in the 4 or 5 Southern California counties, but we've been servicing, for instance, our third biggest market, I believe, is Phoenix, Arizona.
Okay, great. So Arizona, Phoenix, Arizona.
Yeah, we service all of the Western United States. We don't service Nevada. That's a licensure state. So we've chosen not to service it with the licensure requirements. But again, you can go to any of the websites. CAI Online is a great website. They have the reserve specialists there. APRA, the Association of Professional Reserve Analysts, they have data. And as a matter of fact, on the APRA website, you can put in the particulars or attach a PDF of your property and send it to all APRA members to bid on. So if you're looking for multiple proposals for a property, literally within minutes, you can get proposals from dozens of providers that service your area. So whatever whatever part of the country you're in, I assure you, there's a reserve analyst that services you. They may not be next door, but there's somebody that travels regionally to service your area. And so with a few clicks of a mouse, you can get somebody capable of providing you good detailed information about your investment.
That's good to know. So, Scott, are there any last words or last thoughts you'd like to leave the audience about reserves, insurance, HOAs?
Well, HOA specifically, but property investment is general. Be well informed before you make that decision. I, in an earlier career, was in real estate. I have been in property inspection and now reserve studies for a long time. And all of these different providers, whether it be a good, competent real estate professional, a good, competent CPA, lawyer, home inspector, reserve analyst, appraiser, listen to what they have to say. These are smart people. They've been doing it a long time. And don't go into it without good advice, because your outcome is going to be much worse. So I know it's expensive on the front side to get this kind of data, this kind of information, but it's well worth it in the long run when you're talking about the investment that, even a modest home is most people's most significant investment in their lifetime. So take a little bit of time, a little bit of financial resources, and make sure you're making an informed decision, because as they say, you've got to live with it.
My guest today has been Scott Clements. Thanks for coming on the podcast, Scott.
Thank you. My pleasure, Koresh.